Ladies and gentlemen, at Khazanah, building a resilient portfolio is crucial, allowing for sustained AUM growth, improved drawdown management, and stable income and liquidity. However, old approaches are under pressure, with higher interest rates squeezing equity risk premiums, making traditional diversification less straightforward. For this special session on investment portfolio management, we have two individuals who know what it takes to build strategies that can weather all storms and deliver value. Please welcome Jayne Bock, Head of Investments Asia, Willis Tower Watson, Dr. Machin, Founder and Managing Partner of Intrepid Growth Partners, and our moderator, Datuk Hisham Hamdan, Chief Investment Officer of Khazanah National. Over to you, Datuk Hisham.
Us between their lunch, but normally when you think about risk, and I know you will fall asleep and start looking at a phone, but trust me, we have two very experienced professionals that can discuss about risk. I was telling Riz earlier that, hey, take more risk in terms of moderating. So I think Riz, you're not taking risk enough. So we're going to crank up a bit, Jayne and Mark. So I was in Singapore the last few days and talking at a panel and appearing in some of this TV show. They all want to know what sort of alpha move you make. What sort of alpha move that you're going to do, what Khazanah is doing. So that show indication that brains always favor action. They always want to know what are you going to do. I always give them boring answer. Well, I'm not an alpha hunter, I'm a beta shaper, sort of an kind of thing. But actually, and from time to time, I'll give them both answers. The end, we need to think about the future. The grasshopper, we also need to be agile and take advantage whatever it is. Actually, I disagree with the metaphor, Nick. I don't agree with my head of research. It's not ant versus grasshopper. It's not either or. I want to agree with what Datuk Faisal said in his opening speech. Both stroke ant. We need to be both ant and also grasshopper, because the environment can change. Systematic risk can change. So today, we're going to try to discuss this. So stay with us. It may change your life. So it's not just about investment risk. It's about your company. If you're a chairman of the board, various chairmen here, some of my important chairmen, Tenaga, CMB, and here, and the CEO. We're going to talk about systematic risk, systemic risk, and maybe idiosyncratic. That sounds very confusing. Let's boil it down. We're going to talk about type 1 error, the cost of doing things, which is very, very painful. But what is more painful, but normally not measured, is type 2 error, the cost in inactions. So we're going to cover about Kahneman loss aversion, which the professor covered Kahneman's. And he said loss aversion twice as pain, that versus not doing things. Right? So we're going to cover loss aversion versus optimism bias, and I would say we're going to celebrate delusions. What else are we going to cover? We're going to cover doing exploit and explore. We're going to cover, hey, how do we handle today and tomorrow's demand, right? Local versus global. So we're going to cover all this tension and paradox. So we have two excellent individual here. Jayne is head of Asia WTW. She speaks to all the global CEO, CIO, endowment fund, pension fund. And Mark has been investment bankers in this part of the world for many, many years. So he saw the roaring 90s, all the various ups and downs, and also former CEO CPPIB. So he's been a practitioner and trying to implement some of this. And also now founder of, let me get the names right. Oh, it's not that.
Intrepid Growth Partners.
Sorry, can you get a mic? Yeah.
Intrepid Growth Partners.
Yeah, Intrepid Growth Partners. So we're going to cover this. So maybe I go to Jayne first. So Jayne, you mean all this, CIO, head of asset allocation, CEO, and they always talk about, oh, how do we optimize my current asset allocation, i.e. strategy asset allocation. But increasingly we hear about, hey, let's not just focus on that, the world is changing. Systemic risk is coming. So let's more holistic. You probably heard the buzzword total portfolio allocation, but we're not going to go there. But how does people thinking about this, and what sort of mandate are you getting, and what do you think they should do? You know? So.
I mean, the title of this whole event, Debugging Uncertainty, Lessons from the Grasshopper and the Ant, I think is actually quite apt. And I'm not sure how many of you in the room have actually read the concept paper. I felt I was obliged to read the concept paper, and I actually enjoyed it very much. And if you have read it, you'll remember that there was a case study about Kodak versus Fujifilm. You know, this is a famous case study because Harvard Business Review has been, you know, I kind of feel sorry for Kodak because they're always used in this case study. However, they have recovered since. But you talked earlier about systematic risk and systemic risk. And Professor David has also talked to us a little bit about risk and these unknown unknowns. And, you know, Mark will know this as well, but we're portfolio construction and strategic asset allocation, I guess, experts, and that means that we do a lot with systematic risk. Most of our day job rotates around systematic risk, but at the same time, we've come to understand through experience and through the ups and downs of markets the importance of systemic risk as well. And you could sort of see the Kodak and the Fujifilm example is similar to that, because I'm sure, absolutely 100% certain, that Kodak was very good at managing the systematic risk that existed in their industry at the time. Even though they were the guys that actually invented digital back in the 70s, I think they had a researcher at the time who had actually come up with the concept.
So I just want to be clear, systematic risk is equivalent to the beta, and in the KMF say, hey, you cannot, you're supposed to get return only from systematic risk, and the non-systematic is supposed to be diversified.
Going back to Professor David's analogy, if we go to the 100-year-old definition of risk, right, where it's the stuff that can be measured or optimized, right? I'm sure that Kodak was optimizing quite well for what they knew. The risks that they could quantify and the risks that they knew in their industry. What they weren't really able to optimize for or prepare for was the fact that the whole world was about to change. Well, not in the 70s at least, but much later. And this wave of digital. They couldn't, it's the imagination point that Professor David was mentioning as well, the lack of imagination. Even though they were able to sock away enough money and were wealthy enough and successful enough to have the research function that actually came up with the technology in the first place. Right? And I see that happen a lot because we're so focused on what's right in front of us. We oftentimes act like grasshoppers, and we sometimes fail to prepare for the winter or fail to prepare for the things that feel a long way off. So I'll start with that premise, because I do think it's a very apt one. But you earlier talked to me about what am I seeing, right? So what I am seeing is the beginnings of the S-curve in my industry. So last year, I wrote a paper alongside an association called KAIA, the Chartered Alternative Investment Association, that talked about TPA, Total Portfolio Approach. And in that paper, I basically told most of the funds that were going to read that paper that I thought for 95% of them, they shouldn't really think about it. That SAA was probably going to be good enough, strategic asset allocation. So going back to Hisham's introduction, if SAA is systematic risk, the stuff that you can quantify, and based on this premise that certain assumptions are stable, right? We assume that we understand, thereabouts what the risk of this is going to be, what the return is going to be, how they're correlated, and then we build these models that are supposed to predict future outcomes. And that works as long as your assumptions are stable. But what if you have this massive regime shift? What if you have AI? What if you have geopolitics? Things that are thrown into the mix that your models can't capture, right? And that's the systemic risk that you were talking about earlier, Hisham. And so I see the rise of TPA, or Total Portfolio Approach, as a coping mechanism around wider, longer, broader, softer risks that we all need to think about as investment professionals. I'll stop there because I've spoken for a while.
Yeah, we'll come back to that in a bit more. So we go to Mark. Mark, you run big institutions. the cost of action, sort of type 1 error, when you get it wrong, is very painful. So as a result, people are always thinking about, oh, let's think about it, let's calculate this, because it's career risk for the CEO, right, doing something. But people don't quantify type 2 error, the cost of not doing it, or the cost of inaction, or ignoring it. It's like a boiling frog, right? You're not aware of it, suddenly, boom, So what you've gone through, whatever you were trying to change, so what's the cultural or psychology issue of the organization? I mean, share with us your experience, your journey, and how do you overcome that, Or anything that you want to say.
Okay, perfect. Hisham, first of all, thank you for inviting me to this event, incredible gathering and amazing speakers, and I'm humbled to be here. So my history, as you said, I spent 22 years in Asia, 20 years in investment banking. I then joined Canada Pension Plan, CPPIB, or CPP Investments, it's now called, and had the honor and privilege of running it for 5 years out of my 10 years there. And I'm now an advisor to GIC as well, so I have another sort of lens into your world from that perspective as well. And I think one of the things that I've seen, you all have seen, you all lived through over the years is just incredible change and moments of volatility. I arrived in Asia in the mid-90s, just at a time when China put interest rates through the roof and China market shut down. We had the Asia financial crisis, which obviously impacted everybody, very, very profoundly at that time. We had the global financial, we had the tech bubble bursting, we had SARS, we had the global financial crisis, etc. Every time there's been some massive swing, we have unbelievable resilience as people and countries, and we manage our way through all these things. But and every time it happens, it always seems like an L-shaped event that is going to profoundly impact things forever. And so when you think about this and the events we've all been through more recently with COVID and other bubbles, you have to have a bit of humility about knowing whether this is going to be L-shaped or whether this is going to be another V or U-shaped situation. And it is really, really hard to tell in every situation. Always, as you go into them, you think this time is different. The same thing with the rallies. So having that humility, I think, is important, despite all the modeling and all the metrics that you can do and all the scenario analysis that you can do. So that's a little bit of perspective in history. And I think one of the analogies, not to keep going on with different analogies and ants and grasshoppers and other things, but one of the things is to decide, is this just a change of weather, which can go back, or is this a tectonic plate shift? Are these things actually going to change for quite a profound amount of time? And so I think there's sort of three things that people think of as tectonic plate shifts right now, at least three. One is geopolitics. Is geopolitics, is the bifurcation of the world a permanent shift? Maybe the last panel, as you indicated, maybe it's not, actually. Maybe there's some hope that there's, this Plaza Accord event, or maybe the world stitches back together in some predictable way. But at the moment, I think a lot of funds around the world are saying, look, this is permanent. There's a permanent step change here. This is L-shaped, and there's a bifurcation that's going to happen. The second thing, very long term, is climate change. There's sort of a general view in the world, or the US has a different approach to it right now, that climate change is happening, and you should factor that into your thinking, your risk models, how, whether it's geographic risk or physical risk or other risk, it's going to happen. And it's probably going to happen in a more messy way, and you're probably going to end up with a couple of degrees of increase in climate. The third thing is that people think is a tectonic shift is this acceleration in technology. I'm a definite believer in this one. where Kevin is, but I'm more of an ant than a grasshopper on this one, that I believe AI will create big, profound step change in productivity. And I think there's other profound changes in technology that are likely to come at some point in the next 10, 20 years, including quantum, nuclear fusion. So these are going to be profound. I think these are tectonic shifts that are happening. But I don't know.
But Mark.
So yeah, I didn't answer your question. So answer your question. So I think just on this one, there are things that seem very obvious in hindsight that we should have leaped into. But right now, I want to give a couple of examples of things that are where I pushed hard when I was running CPPIB, and there was quite a lot of surprising resistance to it. One was investing in technology and innovation.
Right.
And there was a lot of work that was done in the early days of CPPIB's active programs, where they decided that investing in particularly venture capital and growth capital was, one, it was not scalable. The funds were very small.
We got a bunch of VCs in the room. I see Jayne there. So listen carefully.
Yeah.
What Mark been trying to do.
Yeah.
Yeah,
so there was a lot of work and very sensible analysis done. Funds very small, wouldn't make an impact on a big portfolio. Second, skepticism was through cycle. The returns didn't seem, risk-adjusted returns, were they any better than just investing in late-stage buyout? And so there was basically a view taken, we're not going to do it. When I sat in the seat, I re-challenged that and said, look, things are changing. The world, technology is becoming more and more and more important in the economies around the world. It's more of a source of growth in the world. It impacts everything else in the portfolio that we have. If we're investing in infrastructure or real estate, it's impacting everything in our portfolio. We are more blind to it if we're only investing super late, and companies are staying private and scaling into very big companies for much longer. And if you're not in them at an earlier stage, if you're waiting just before the IPO or the IPO, you're going to lose a lot of value creation in the portfolio. But it wasn't easy. I mean, because there's a lot of people who've done a lot of very careful work before who were very resistant to doing that. So the effort to push an organization into making a change when they've already done the analysis before, there's an inertia. It's not a dumb inertia. It's a thoughtful inertia. They've done a lot of work, so it's hard. I'll give you another example of one today that I think most people will think, no, you shouldn't do that, but who knows? Crypto.
Yeah.
Crypto. Should you invest in crypto? $4 trillion asset class.
Already.
I mean, astonishing. But $4 trillion asset class there that is available to diversify into. But should you? And when I analyzed it, when I was at CPPIB, I had lots of young people were super interested. Anybody under 40 is a massive believer in crypto. And so I had hundreds of people within CPPIB who were passionate about it. I had, all Mr. Bitcoin come and present to us, and I also had arguments that we should be doing Bitcoin mining. We had access to very low-cost electricity, so we could have done a lot of Bitcoin or crypto mining. I decided at the time it was too early. We were not even invested in gold, which I can come back to on that one. But to invest in digital, it was just a leap too far. But it's a question. Should we?
I have a sympathy on both sides of the argument, right? In this part of the world, certain asset class is very, very painful. But if you're running a country, I'm using the metaphor of the trees of growth. There's a root, and there's trunk, and the branches, right? The leaves. So, I keep on saying you can just take care of the roots, but you got to allow the trunk and you got to allow the trees to flourish. Otherwise, you're going to have a bonsai tree. But at the same time, if you allocate so much money, to the branches, and the root become weaker, then the tree will fall. So we need to do both. But I can appreciate from allocator perspective why sometimes we see it difficult. So I have something that we need. So maybe I just switch the argument. Jayne, you started as a sort of HR reward practitioner before you move to the left side of
Yes.
this. All this thing about what Mark just said, incentive or psychological barrier or mathematically they haven't calculated properly, and we can talk about the wrong type of snore kind of thing.
Well, I mean, a lot of people, even within my own organization, have no clue that I actually started off life as an HR consultant. Actually, on the stage, you have an investor and you have an investment advisor. But before I was advising on investments, I was actually a human capital consultant in Korea. And I had entered the workforce just after the Asian financial crisis, which the Koreans call the IMF crisis, a very shameful period in our history, as our parents will remember. I saw my parents line up to sell their gold to help the country. It was a time where a lot of the things that people believed in, a lot of the big names that we'd seen all our lives, a lot of the companies that I was expecting to join basically went belly up, including the main chaebol that supported my alma mater, Yonsei University. So Daewoo basically went belly up. And so it was a hugely disruptive time. But in those periods of crisis, I guess there's always the silver lining that you are forced to change. And Korea has gone through a lot of upheaval and change over time, right? Whether it was Japanese occupation, the Korean War, there was these constant resets, both to society as well as to the economy. That's very disruptive, but it's also sometimes a good thing. And it does give you opportunity. So I saw firsthand, because basically, as a young grad who knew nothing, I was going into all of these companies who were basically freaking out that the barbarians were at the gate, because part of the IMF loan was to liberalize Koreans' markets, right? The conditions were we had to liberalize our markets, we had to allow foreign competition, we had to compete head-to-head with global companies. And for lots of different reasons, we didn't feel we were ready for that. But I recall all of the pay for performance at the time, it didn't even exist. It was all seniority-based. We call it the hobong system. And so all of my projects in the beginning were about actually introducing KPIs and performance measures and ways to actually remunerate people based on performance, because the view was that if we were going to compete globally, we needed to become more competitive. So that's just one example. But I think when it comes to changing people, yes, it's oftentimes because we're forced to, but it doesn't always have to be that, right? The change that I'm seeing within portfolio construction, I'm going to bring it back to that now, is that people realize that the old tools, the things that we've been using to build portfolios, are based on 50-year-old theory, model portfolio theory, if anybody studied that, Markowitz. I mean, a lot of the bones of what we're doing are still based on concepts that are 50 years old. And the world has obviously changed since then. And so there are many investors, including one of the founding fathers, in a sense, of TPA, sitting on the stage right now, who have actually sat down and thought about how can we do portfolio management better. It's not, one thing I would say is it's exactly what Professor David said. It's a spectrum. Right? SA and TPA is not like a light switch that you turn on and off. It's actually a spectrum, and there are many degrees that you can go on this journey. And CPPIB didn't start there from day one, but they were not afraid to think differently on numerous fronts, including how they managed talent, right? How they thought about risk in the portfolio, and then how they weaved those things together. But you're right, Hisham, that it does come back to incentives. Right, so that reminds me of Stephen Landsberg and his armchair economist book. He wrote that in 2012, and he said basically people respond to incentives, the rest is commentary, right? And so to effect the change, and I saw this as an HR consultant as well, you have to change the incentives.
So I'm just thinking about, as you were talking, the CEO, senior management, and the board here. Hey, you guys do not want us to think in silos, need to think holistically, as in the investment balance is TPA. But my shareholders, all they want is dividend, and they don't even allow me to venture into new things, right? They say, no, stick to what you do best. For me to diversify, I can diversify. You do whatever you do, right? So that you become a bonsai tree as best as it is, right? Don't try to do anything else. So I'm just looking at some CEO, whether PMB, whether they're allowing their company or Khazanah, whatever, to grow, because we've seen some massive failures also, some of these companies trying to do something adjacent or something outside there. So Mark, we are sort of asset owner, and you were asset owner. And again, you know, I'm looking for the impediments, right, the barrier, the psychology or the culture, whatever it is. Hey, we're making a lot of money. If you look at whatever you said, the last 10 years, when I tried to tweak a bit in terms of my tactical, whether you're talking about developed world or part 120, the market keep on going up and up and up and up. You know, the public market has been done well, private market not so great of late. VC, the special return so big, and you have to really believe you can pick the best managers. So there's a lot of argument. Just hey, stay it is. I keep on saying timing the market better than timing the market. It's safe, give me return. And why should I do differently? Why should I buy call options, insurance? That costs money. So psychologically, I mean, and how do you, what your experience?
Yeah, but, I mean, there's a lot to unpick in that.
Yeah.
I mean, I think, you know, why try harder is the essence of your question, particularly when things are going well.
Yeah. I enjoy what it sounds like. Just,
and
you know.
and it's, you know, one of the exercises, the mental exercises we used to do, and sort of how we were measured was you're measured against what you could do if basically everybody left the building and you were left with, you know, one person and a computer. And you measure yourself versus that. You know, what's the alternative? You know, what's the simple alternative? And you could get more sophisticated than that. You could say, you know, nowadays you can do a lot of things with ETFs and, you know, and other stuff. You could do a lot with, you know, two people. So we try and justify our existence by what value can we add, net of all the cost, all the infrastructure, all the offices, everything that we were running, all the external fees and expenses we're paying. We had to justify that we were adding value over and above that. And we can, you know, you can get into all the different ways of measuring that, you know, whether you call it alpha or value add or whatever. But over a long period of time, not over a quarter or a year, but over some long period of time, are you actually adding value? And if you're adding value, you know, it compounds over time. You know, that money that you've made, then, you know, we know that the magic, the power of compounding, it becomes very, very meaningful for your beneficiaries, your pensioners, or your country.
Yeah.
And so that's why. That's why we try hard. That's why we do more, and that's why we try and do more than just, you know, just the passive. And you need to be honest with, you know, we all need to be honest with ourselves. Are we actually adding value over and above, you know, what we could do with a lot less? And, you know, sometimes, you know, there's moments of uncertainty for a short time, and, you know, governance will challenge. So that's where it comes back to having, you know, a long-term perspective on that value add. But
they say long-term
that's
would
what
be
we're
dead.
trying to
You
do.
know,
That's
I'd be
why.
fired by my CEO if I, you know, the board if, you know, taking too much risk. You know, even though long-term that it should be good. You know, so how do we handle that? How do we provide assurance to the management? Hey, take a bit more risk. You know, buy some call options. You know, because at the end you have this monthly reporting. They say, oh, you underperform, all right? And look at this. It's very hard. After a while, it's, you know, why bother? Just
how you define your purpose, right? Like pensioners and providing pensions is a very clear purpose. We just heard this morning from Dr. Faisal what the purpose of Khazanah is, and your purpose is very clear.
Yeah.
Right. But you're not in the business of beating benchmarks.
Yeah.
Right. You are in the business of advancing Malaysia. And yes, there's a commercial return associated with that.
No, we're okay. I'm just asking on behalf of the CEO of business unit, multi-business unit here, and how did they convince to the shareholders, right? Just help them out.
But
not for me. You know?
But I think that Management 101 has sometimes blinded us. It's almost like we're those horses with their blinkers on, where we only see what's immediately in front of us, whereas thinking more holistically about risk. I mean, total portfolio approach, it's jargon, TPA, whatever you call it, but at the end of the day, it is about thinking more broadly about risk and taking the blinkers off. And instead of just optimizing for the one thing, regardless of whether that's dividend, you know, or shareholder return, you know, you're actually optimizing for a broader range of risks and a future. and a vision. And so I think it's actually equally, applicable to a corporate setting, right? Because TPA is, like I said, it's not a model. It's about how do you unlock information and collaboration across your many talented people and business units, right? Whether you're talking about a portfolio or a portfolio of companies, and I'm sure, as an owner of a portfolio of companies, Mark will think the same, but that thinking, the ability to actually create those connections is hugely valuable. Hard to quantify, but hugely valuable. And there's only a few that can actually do that successfully because they're all just focused on their silos and optimizing this, and this in isolation, rather than thinking about the whole portfolio.
I said the other way, going back to your original question, how do you get over this, institutional reluctance to try new things? I mean, the approach we had, again, was to crawl, walk, run. And so you don't go in massively in some new strategy, but you experiment, maybe you
fire bullets, and then you fire cannonball.
You invest with maybe some external partners, you learn from them, then you build some internal capability, and then you scale as you build expertise over time. And one of the great privileges of our types of organizations were that long-term mindset, that long-term time frame, that long-term stability of capital, which is it's a massive privilege and strategic advantage. So you can take your time. You don't need to suddenly go massive into some new area. You can crawl, walk, run as you build your capability. And if you decide over time, over some longer period of time, and this is where I'd always run into challenge, because I say at CPPIB we can't be great at everything. There's got to be areas where we're not that great. And there's a couple that when I sat in the seat, I shut down because I said it's clear to me after 10 years we have no inherent skill internally, so we should be going back to an external approach on them. One of them that's very challenging, and it's the one that we all want to talk about on every stage, is macro, actually. A macro, we had a quantitative macro group at CPPIB that consistently lost money year after year after year for 5 to 10 years. I shut it down. We tried it again with a discretionary macro group. That's now been changed, gone back to a quantitative group. Macro is probably one of the hardest things for almost every fund to get right. It's the thing that we always talk about on stage. Where's the work? Where are macro markets going? But it really is one of the most difficult skills in investing. So we had skill in portfolio construction. We had skill in selecting one company over the other company, one building over the other building, in real estate and real assets and credit. We could develop all of these things internally, but macro skill was quite challenging. Kevin may have fixed it now. He's arrived at CPP, but
Kevin Bong.
I think he'll probably be on to
so
it.
Jayne, I just want to remember you talked about persistent, whatever, but I just want to introduce this Kahneman's loss aversion, where the pain is twice as much versus the same amount of gain. So that's always a hindrance. Our life is handling between loss aversion and optimism bias, human beings. So in this case, for us to persevere, should we celebrate sort of delusion, you need to overcome that loss aversion twice as pain, right? And you talk about persistent, stick it through, all this kind of thing. So maybe you comment on that.
So you were earlier talking about the roots, the trunk, and the branches. Like, can you imagine a tree with no branches? I mean, it would be a pretty ugly tree, right? So I think
But it's a good ROE, though. For the shareholders, they will say ROE is good,
So to the point about, and we were all part of this experiment just a minute ago, right? Where negative 75 points or whatever it was, if you got, if you were overly confident. I sense the humility in Mark's view. We also, as consultants, we make mistakes and we also get things wrong. You have to give yourself permission, because what is the common denominator for everybody here in this room? We're all dealing with the same macro environment and the same uncertainty, right? We're all trying to navigate very dangerous waters and thrive while we're doing it. We all have different competitive advantages that help us, through that process. And we earlier talked about a spectrum. Like when I'm telling a client to try to make a change and going from this to this, I never tell them to go straight from 0 to 5. We actually have a diagnostic tool now that tries to rate where a fund might be on that journey of being more holistic in its thinking and adopting TPA. And a 0 is basically the starting point, the traditional SAA model, strategic asset allocation, whereas a 5 is what we would call, the full one fund approach of TPA. And I'd say out of all the funds I've spoken to and dealt with, I'd say CPPIB is probably the closest to a 5 that I've ever seen. But it's very difficult. But CPPIB has spent years getting there. They didn't get there all at once. They spent years getting there, and they've built so much what I would call structure and scaffolding and strong bones to enable that even if there are changes and shifts, it's not going to regress fully back. So I'm going to actually talk about a different risk entirely, Hisham. And
I just quickly before we go there, I'm going to challenge that. SAA is great. You public market, just outperform. Private market, you outperform the public market, right? Very shallow. So the center doesn't have to have, maybe the center can have 20 people, CIO office, right? The moment you become holistic, trying to bring everybody together, become sort of KPI, becomes socialized, you need, 300 people at the center.
You don't, actually, you don't. I will challenge that.
All right.
You do not. You do
and
not
suddenly
need
CIO had to make all the decisions. So why don't you,
Remember what Mark just said, crawl first. But I can give you some words of advice. So we wrote that paper in 2024. We talked to 4 funds, including CPPIB. I can announce now that we're about to drop the second paper, the sequel paper. It's going to drop October 7, Eastern Time, and it's going to be basically from concept to execution. It's going to focus more on actually moving and transitioning. And we spoke to 12 funds, not just 4 funds. So this is going to drop Asia time zone, I guess, October 8th. You only have to wait 2 days. But that first baby step, going from a 0 to a 1, right? You do not need 300 people.
Okay.
But what you do need to do probably, and this is just based on the interviews, because we interviewed all 12 CIOs, you do need to, in my personal opinion, you need to start with the people pillar. We identify a couple of pillars for this transition, including governance, including risk, including sustainability, including investments and people. But we actually flipped the order around to have people first, because what we found is that it's very tempting to just tinker with the investment model and just change the engine. And you think, oh, I've got this car and I've changed the engine and now I'm like a Formula 1 race driver, and that's not the case, right? You actually need to change mindsets first. You need to have the mindset of a race driver.
I need you to pay attention to this.
You have to have the mindset of a race driver first. You need to have the people bought in, and that brings me back to incentives, because people only change with both intrinsic as well as extrinsic drivers, right? So you can't just change culture and not change incentives. You need to change both. And what we saw through the interviews was a lot of funds who had started down the TPA path, they were pulled back. They were pulled back by gravity. They were pulled back to SAA after the leader changed or something happened. And one fund told me that it's a little bit like swimming upstream. As soon as you stop swimming, you're just dragged back downstream.
I can empathize with that. I'm struggling right now. So go ahead. I'm struggling to get people together, people to talk together. It's hard work, because
it's very hard work.
Leave me alone. I just do whatever I do. No, I keep on talking, keep on.
And I have another fund in Asia that was actually telling me, maybe we should have done a little bit more to try to change hearts and minds, right? Yeah. Because you see this at a lot of the funds, and it's happened more recently with a fund I shall not name in the US, where they actually adopted it a long time ago, but have only been able to make more progress recently, and that's because they finally started to focus on the people side.
People side.
Yeah.
So, Mark, your experience, you've seen this, Mark. Yeah. How many, the center, how big, and looking back, is there a lesson learned? So?
Yeah. So, reflecting on this, a couple of things. One is the CPPIB was quite lucky in a way in that it started off with that mindset of the total fund right from the beginning, and then gradually built out asset classes and then invested in those, and then built infrastructure to invest in those asset classes. So its origins when it started was always with that total fund mindset. So it didn't say, oh, we're going to do start a real estate department, and we're going to start a public markets department and just fill the asset buckets. It was always from a total fund mindset. So it came at the challenge was from a different perspective, which was as you try and move the total portfolio, you've got all this embedded infrastructure and cost, people and offices and all the departments and stuff that go with it, and partnerships, that it's all very well theoretically at the top of the house to say, oh, well, we're going to shift the portfolio, but then it affects a lot of people and a lot of embedded expertise. So you can't shift really quickly, or if you do, then you're probably at the cost of going back into that area, because ultimately laying people off from those areas because you find them no longer interesting for the moment is it's difficult to get them back again. It's difficult to reopen offices. So there is a bit of inertia that's inherent with scale and building out different strategies. But we were, I think the philosophy and the approach of going from a total fund and thinking about what's the risk level you want, what are the exposures that you really want the portfolio to have access to, rather than just inheriting them through your the businesses, the investment businesses you built out, I think is the right way of going about investing. So and incentive structures, ideally you have incentive structures that encourage people to have enough courage to be bold enough to go out of consensus, because that's where money's made. It's being out of consensus, taking views that other people don't have, holding them for a sufficient period of time through the doubt, having conviction when they continue out of favor, and being able to load up on them when they're out of favor and then be rewarded in the long term. That you need incentive structures that are going to be able to do that, and so you need 5-year plus, rolling type incentive structures. Whatever people's careers and personally they can tolerate, but as long as the institution would love it to be as long as possible, because that's where the institution will benefit.
Panellists, almost coming to the end. I've been challenging. Jayne, you've been talking, hey, let's do more. Let's be holistic. I agree with that. We need to do both, not just be a ants or grasshopper. We need, because the climate is changing, right? You need to be both. You need to be agile, so grasshopper can fly, and still prepare the world. So, what are the final words in sort of 2-3 sentences? I'm going to play something after this. What are the final 2-3 words to encourage the CEO, the chairman, or whoever managing fund? Hey, don't allow just silos to happen, right? Because you need to try to get synergies of working together. Therefore, we have to look at risk differently. And so 2-3 final sentences.
Yep.
Mark as well. Yeah.
So if all you're talking about is asset allocation or capital allocation, if that's all you're talking about, you're still in SAA land. If all you're talking about is risk, you're getting closer to TPA. This morning's keynote, and I'm sure everybody was both highly entertained and learned something from Professor David. I did, most definitely. I thoroughly enjoyed that session. But what I just told you was not my quote. That was a quote from a North American fund that is trying to make this very difficult transition. And so it is shifting the mindset to think about what's flowing through the portfolio. I'm going to give you a metaphor. I know you've already given the audience a lot of metaphors. The metaphor that I use, it's not a perfect metaphor, is a glass full of ice cubes, right? When we think about our businesses or we think about our portfolios, we think about them as asset class buckets or as companies or units. Distinct, separate, P&Ls. What's it made up of? It's made up of H2O, right? Now imagine a glass of water, much more fluid, right? But it's the same H2O. The same risks are running through. We are all going to experience the same risks, right? But you have this ability to basically flow. And I think the ability to unlock the potential through a better understanding of the common risks that are flowing through a portfolio or through an organization is hugely valuable. It's not the only thing, obviously, but that would be the metaphor that I would leave with you is, are you going to stick with the blocks of ice in your glass, or are you going to add some water and have some ice water with your ice? It's possible to have ice water, that's fine. Or, are you going to go all the way and just be free-flowing water? Regardless, I think we all realize that in today's world, we do need to be agile, right? I don't think anybody here in this room is thinking that by hunkering down and just sticking to my guns, I'm going to somehow be successful. So I think we all realize that something has to change.
Yeah, in a non-linear world anyway, it's not linear world, right?
One thing I would say then is that you need a system to manage a system, right? If you're trying to deal with systemic risk, you need a system to do that, and incentives play a big part, obviously. Do you have incentives in place that basically reward risk-taking? Yes or no? Or do they, reward playing it safe and sticking to what you know best? Do you have...
Well, they will say, of course we do. The moment people make a mistake, out you go. So right. I got to go to anything else? Sorry, yeah.
I think that what I'm trying to say is that these are human problems that we're talking about. We're talking about behavioral problems. Yep. Whilst we can't fix everything about humans, I wish we could, but we can't. This is something that you can solve for, but you do need to put some work behind it. You need a system to solve for a system.
Thank you, Jayne. Mark, 2-3 minutes, because we literally have, I got to leave for 2 minutes.
So I'll just say two quick things. One is we should all challenge ourselves to, if there are big opportunities out there, big things you could diversify into, big market opportunities, big investment opportunities, why are we not doing them? The type 2 error. Why are we not tackling that potential investment area?
Because type 2 error is not being measured. You can't see it.
Exactly.
But it's much bigger than the type 1 error.
What gets measured gets managed.
You challenge yourself.
Yeah.
So
type 1 error, you can see the
I invest in these geographies, I only invest in these areas, this is my... Then why not? Just, it doesn't mean you need to do it, as I mentioned with crypto, but you should have a sort of... we want a well thought out view why not, and what would be the indicias of when you would do it. So I think challenging, there are other opportunities out there, should we be doing them? And that might lead you to do really interesting things. And then the second thing is, on the things that you're doing, just challenge the underlying assumptions all the time, on a regular basis. The one I always think of is infrastructure investing, long-term toll roads, bridges, tunnels, airports, etc. The assumption that we had was that developed market infrastructure was very stable, long-term dependable. Emerging market infrastructure, highly risky, not sure we should do too much. And it turned out certainly over my time, that emerging market infrastructure, we were lucky, we have very good experience, quite stable. And developed market infrastructure, we had everything from tax change, regulatory change, up to we almost had Jeremy Corbyn invested in the UK, where our asset would have been nationalised. So it was pretty close. So the risk in developed market was way higher than we thought. And I said the biggest loss we ever had in our portfolio was in Norway. It was a gas pipeline from Norway where 6 months after we made the investment, the government cut the tariff by 90%, having told us they wouldn't do that. And we sued them all the way up to the Supreme Court and lost. So I challenge the underlying assumptions of the strategies that you're in as well. But I'd say on the glass half, look for those big opportunities and challenge yourself while you're not in them.
Thank you, Mark. So before we close, let me leave you with a final thought, not from the panelists, not from CIO, but from a poet. It's a reminder that in both investing and life, the greatest risk is never taking one. So we're going to play William Arthur Watts to Risk.
To laugh is to risk appearing a fool. To weep is to risk appearing sentimental. To reach out to another is to risk involvement. To expose feelings is to risk exposing your true self. To place your ideas and dreams before a crowd is to risk their loss. To love is to risk not being loved in return. To hope is to risk despair. to try is to risk to failure. But risks must be taken because the greatest hazard in life is to risk nothing. The person who risks nothing does nothing. Has nothing is nothing. He may avoid suffering and sorrow, but he cannot learn, feel, change, grow, or live. Chained by his servitude, he is a slave who has forfeited all freedom. Only a person who risks is free.
So, ladies and gentlemen, don't be nothing. Risk and aliveness are the same thing, because the greatest danger isn't taking the wrong risk, it's taking none at all. So, all of us, let's keep risking wisely while still alive to do so. Thank you so much. Join me to give a round of applause to the two panelists, Jayne and Mark. Well done. Thank you.